All right, Palantir and other high-growth tech startups and the rest of the market, to be honest, is crashing today, and we need to talk about why. There's a couple of unique catalysts that have occurred in the past couple of, to be honest, hours that have caused the market to crash, and I think we need to understand why it's happening, how it's happening, and ultimately how we're going to get through this, or if it's going to be a little bit more of a colder winter that's coming up. So a couple of hours ago, I posted a video about Palantir signing a new $25 million partnership with Hyundai Heavy Industries, which is a new partnership and joint venture they're basically launching that is going to create a new data analytics platform for ships and manufacturing processes. This is really good news. Like, it's awesome stuff. And a lot of people are commenting and people are talking on Twitter about why is the stock falling to all-time lows. Let's check where we are right now as I'm recording this. I think when I put out that video, it was like $18. Right now, it's at 1702, likely going to break 17 and go under. The reason why this is happening is because of external market conditions, and the reason it's happening for other stocks as well, not just ARK and high growth tech stocks, but really the entire market. I'll put a picture right up here that shows you that the entire market is red, and we're going to talk about exactly why it's red. Is because stocks and whatever stock you're invested in right now, I don't care if it's a super high growth tech stock or a super good value stock, it is detached from the reality of the company right now. What I mean by that is when a company launches a brand new partnership with a South Korean behemoth that controls most of the world's ships and the manufacturing of the world's ships to create a new data analytics platform, that is news that should generally help the stock, generally help the price of the company, because you're seeing the future potential that news could launch. But the stock is detached, or the price of the stock is detached from the reality of what's going on in the business. And that is because of these external market conditions. So whatever good news that's coming out about whatever stock you're invested in, it's likely not going to affect the microeconomics of your stock, because there are macroeconomics that are affecting the entire conditions of the market, making it very volatile and ultimately leading to a sell-off. And this is the important thing before we get into it, to understanding what is microeconomics and macroeconomics. Microeconomics is your day-to-day interactions within certain things, understanding how certain things fluctuate and go up and down based upon how you spend, right? Really like transactional relationships that you have with certain products and services. Macroeconomics are global events, political events, things that the Fed, which is an apolitical institution, at least in the United States, that has to institute policies, monetary and financial policies that actually allow the economy to either go forward or go backward. We're talking about inflation, stimulation, deflation, rising interest rates. All of these things are macroeconomic trends. So it's very important to understand that when you're in a stock and you have conviction about the stock and you put a lot of money into that stock and it's dropping and you're like, I don't know why it's dropping, it's incredibly important to understand the nature of macroeconomics, because that's going to affect likely every stock or every investment that you're in, regardless of the sector that you're in. Now, why is this happening right now? I'll put a screenshot on the screen right now. This is the notification. I got the notification, as you can see, at 2:17, and as soon as I checked my Robinhood, like, the entire market just started crashing. Fed officials said a growing economy and higher inflation could lead to earlier and faster rate hikes, according to minutes of the December meeting. So the December meeting, again, this Fed is the apolitical institution that determines all the policies that are going to enhance the economy and going to move the economy forward. Their minutes are basically the notes that they take from the meeting. Those are released every month after the meeting is done. In this meeting, the December meeting, they said, hey, things are getting kind of bad and growing inflation is happening. So obviously they're looking at their data and they're like, we've really got to put an end to this inflation stuff, which is why they are increasing interest rates. Now, from a macroeconomic perspective, what does this mean? When you raise interest rates in an economy, stocks tend to fall in a lot of sectors, especially high growth tech stocks, because it costs more to borrow money. And those high growth tech stocks that are not cash flow positive, that have to borrow a lot of money, that they don't have a lot of profits because they're trying to go after market share, they end up having a big sell-off, because investors know that we should rotate our money from those stocks into other stocks, because it's going to be harder to grow in an environment when interest rates are higher, when you have to pay more to borrow money in and of itself. In general, the economy tends to slow down when the Fed raises interest rates, because the Fed is explicitly trying to get people to stop spending money, because there's too much money being pumped into the economy. And they're trying to get money outside of a lot of assets like the stock market and into other different things, because when there's too much money being pumped in, that's what leads to the dollar being inflated. And inflation is obviously bad. There has to be a very thin line the Fed has to walk over decades and decades to make sure inflation does not get too high and does not get too low. Right now, inflation is pretty staggering. It's the highest it's ever been since the 1970s. So obviously the Fed is taking some pretty strong measures. Now, the reason the market is reacting to this is because this wasn't supposed to happen until May, right? There's supposed to be 3 rate hikes. I think earliest was going to be March. But now the Fed is saying, hey, like, it might have to happen sooner than that, right? We might have to really start doing this because inflation is getting pretty bad. So obviously the analysts and the data people in the Fed are just like, this is not the best thing right now. And because this is not the best thing right now, we might need to raise interest rates. As a result, the entire economy, the entire global economic markets are deciding to start to go lower because investors are selling off. Why are investors selling off? Because why would I put my money in stocks in which it's going to be harder for them to borrow money? If macroeconomic trends ultimately sustain themselves, then I should probably take my money and put it into other assets, which leads to a natural sell-off. The next thing that's important to talk about is that most of the market, and I covered this in a couple of other videos, is run through algorithmic trading. Algorithmic trading is basically when a stock is selling off. So let's say from Palantir, it went from 18 to 17, 1790, then 1780, 1770, and it just keeps going lower and lower. That's not a natural thing to happen. It's not like people are waking up, they're looking at this position they have in Palantir. It's probably a very long position, or at least because most people believe in the company, they invest in the company for the long term. And then they're like, oh, screw it, I'm just getting rid of my investment. Like, I'm just going to sell it off. That's not what tends to happen. What tends to happen is institutions and hedge funds, people that are trading the stock on a short-term basis, maybe not day trading, but rather trading it, buy 50,000 on day one, sell it for 51,000 day two. The way that operates, they're run by algorithms at the end of the day. 70% of the market is run by algorithms. So when there is a sell-off, the algorithm is doing the objectively right thing that it knows to do, which is save money for the firm, which means it should maximize or profits and minimize losses, which means it also continues to sell off. Well, when one algorithm from Chicago is selling it off, the other algorithm from New York is like, well, why is that Chicago algorithm selling it off? And then the algorithm in San Francisco is like, why are Chicago and New York selling it off? And then you have algorithms in Hong Kong saying, why are Chicago, New York, and San Francisco selling off? And it's this compounding effect of selling off the stock, which leads to more fear in people because they're seeing their stock price go low, which means retail starts to sell. And then you just have this flywheel effect of selling until, things start to stabilize and then people start chasing it as it goes back up. This is what's happening in the economy right now. The Fed has raised interest rates. People are very scared about interest rates rising, and algorithms are simply interpreting what the reaction is to interest rates, which means they're just going to compound more of the selling off. Now, how do you get through this if you are investing in the stock market? So I've been invested in the stock market for a couple of years. This is the first time outside of the March 2020 pandemic am I really kind of experiencing a large-scale sell-off, even a little bit harder than it was back in November of 2021. And I want to read this thread that I'm going to put on the screen. It has to do with ARK Invest. It's not necessarily just about ARK Invest. It's about ARK Invest, but I think there's a metaphor in there that I would really like to read. And I retweeted it today, and I think it was really important. So let's put it on the screen right here. I'm going to make a contrary opinion and publicly defend Cathie Wood and ARK Invest. This is from Simon Erickson. It seems like everyone is calling for her head right now due to ARK's underperformance in 2021, but I believe that is short-sighted and misses the point of how disruptive innovation works. I've read multiple reports that are critical of ARK's lack of internal risk controls. Modern portfolio theory teaches that funds should have a fixed position limits and keep a close eye on internal correlations. This is to minimize high beta volatility during sell-offs. This is something that Cathie does not do. She doesn't have all these fixed internal controls within her fund in order to make sure that when it's bleeding, it's not bleeding that bad. When it bleeds for something like ARK and innovation or any other high-growth tech stock that you may be in, it's going to bleed pretty bad. Other critiques have started saying similar things, mostly citing how ARK's outsized positions and extreme ownership stakes in smaller companies unnecessarily expose its investors to broader market volatility. Redemptions require ARK to sell shares, sometimes in illiquid positions. This is sort of the buy high, sell low scenario that happens with ARK. These criticisms aren't completely unwarranted, I agree, especially for institutions. If you're managing a pension fund, you want to have controls that ensure your assets aren't always going to be too volatile, and that cash will always be available for those who need retirement income. But the ARK Innovation ETF isn't the same as most institutional funds. It's much more like a VC fund. And furthermore, disruptive innovation doesn't follow quarterly earnings reports or happen on an annual timeline. It all takes years of waiting, and then it happens all at once. Before we get to the final tweets in this thread, that's the main idea here that's very important to understand. So it's talking about ARK, but for some people who are watching this video, you may be in a high growth tech stock. A lot of you may be investing in Opendoor or SoFi or Palantir, what's another good high growth? Peloton or something. Peloton it's already had a decent follow, but it's falling even more, right? So like the point is, it's important to understand what disruptive innovation means. Disruptive innovation, the company that you chose to put your money into, right? Regardless of whatever reason you chose to put your money into, you were like, hey, I think this company is going to be at the leading edge of frontier technology in the next decade, so I decide to put my money there. That doesn't operate on a quarterly basis, right? ARK is not operating on this sort of quarterly earnings report that all these other hedge funds and institutions have to abide by, because innovation in and of itself takes slow years of growth and progress, and then exponentially happens all at once. And you can't time when that's going to happen, so you decided to get in early and put your money here while prices are pretty low, pretty stagnant, while the rest of the market really doesn't believe in the innovation, but you do, which is why you've invested in that company, which is why I've invested in some of these companies. And then it happens all at once. Examples of disruptive innovation that have happened all at once: EVs, blockchains, autonomous robots, gene editing, space economy, metaverse, quantum computing. Years of dedicated research, but then the mass market embraces them rapidly. We call these S-curves. S-curves are when things happen from an exponential basis, and when these things happen, they happen in a pretty interesting way. A VC fund, which he referred to in a similar tweet, is more so about allocating capital to a lot of different startups that are really highly unproven, and then when they blow up, they blow up. So for example, I've talked about this in previous videos, but Andreessen Horowitz, a leading VC firm in Silicon Valley, invested $200 million into Coinbase with, I think this was their Series C round back in like 2014. And when Coinbase went public, they made $10 billion off of that, right? So like it took 7 years for it to happen, but when it happens, it really does happen. And I'm not saying you go make a bunch of bets on a bunch of like these small growth tech companies, but the companies you have conviction in, you have to give them time to develop, ultimately for them to come to their fruition long term. The final tweet in this thread was, so those lack of internal controls are actually exactly why ARK has had such an incredible run during these past few years. It took an outsized and very controversial stake in Tesla. This was very controversial. Kathy going on CNBC every day saying, hey, it's going to go to 4,000. And they're like, you're nuts. Now it's at like, almost 5,800 or something after the split or pre-split, and have conviction to let it ride as high as the fund would allow. So my point here, the metaphor I want to take away from that thread and the message I want to leave with people today to really understand about the market is like, you've picked certain companies to invest in. And you either have conviction on those companies or you don't. And if you don't have conviction, my advice is to go get conviction. Stop looking at your portfolio. Stop looking at all the red. Stop looking at the blood. Recognize that you didn't pick to invest in Palantir or SoFi or Open Door in 2021 to then exit in 2022. And if that was your plan, that was a really bad plan. I picked to invest the amount of money I invested in Palantir in 2021 because I don't want to see it until 2030. And I'm serious about that. Like, I'm actually serious about that. Now, if the price goes to like 300 tomorrow, am I going to sell? Probably. But I know that's probably not going to happen as well, right? So you have to understand and not be naive about these things. So when you recognize that you're investing in a company for the long term, that means in the short term, which has been a couple months since I've invested in my main position, there's going to be volatility. There's going to be blood in the market. There's going to be people doubting you. And if you don't have conviction, you, like an idiot, will sell. Why am I saying like an idiot? Because I was that idiot that sold my Tesla before everything went bonkers. Not every company is going to be a Tesla-like type of investment, but if you've done your due diligence and you genuinely believe in what you're investing in, you should not let other people talk you out of it, because then you're never going to be an investor that has any level of conviction. If anything, let's say you're wrong and you lose at the end of the 5 years, you will be able to stomach that and you will take lessons that you've learned from that, not trusted some random people that you talked to or trusted some random articles that you read in terms of influencing your decision making. If you're trying to become a truly long-term investor, an investor that has conviction in the investments that they make and an understanding and a rationale between why you're making that investment, then you need to believe in it. And if you don't believe in it, then sell and don't buy back again when it starts running up, because then you're just going to be this person who's chasing the market. I've been there. I've done that. I know what it feels like, and I refuse to be in that position again. If I made an investment and I believe in it and I've put the money that I can afford to lose, which is the most important part in terms of being financially responsible, then these prices to me are just a beautiful, juicy dip. And you have to recognize the macro level conditions that are causing these prices in the first place. And if you're able to understand that, then you're going to be able to sleep well at night. But if you're not able to understand that, and if you're naive about the market, then you're going to sell or be scared or lose sleep. And that's not good for anyone's mental health. That's a toxic mentality. And it's very important to grow out of that, especially if you're trying to become a strong investor. And I'm not the strongest investor yet, but I'm trying to develop that process. And this is the mindset that really helps me get to that point. So that's all I wanted to say today. This is why the market is crashing. This is why a lot of stocks are crashing, not just high growth tech, but pretty much everything. It's macroeconomic concerns. Let me know what you guys are thinking in the comments. Looking forward to reading them. My name is Mitt. Thank you guys for watching. See you in the next one.